Welcome to this course. This is getting your business investor ready. If you are on this course, it could be that you have an awesome, brilliant business idea and you're looking for funding to get your business on the road, or you have an existing business but you need funding to grow your business, you need funding to expand, you need funding to scale your business. So whatever bucket that you fall into, you are absolutely welcome to this course. Please stick with me till the very end of this course. I promise it will be a very, very good use of your time. So, a little bit about me. My name is Bawa Ogunro. I'm a healthcare professional and operations expert with over a decade in business development, health management, operations, sales, and marketing. I've worked with loads of businesses and have very core experience building businesses from the ground up. In my previous experiences, I've worked with Sanofi, the Center for Disease Control and Prevention, CDC in the US, building public and private partnerships, and currently work with a health tech startup. In the most recent project that I worked on with a group of team members, we'd raised over $500,000 in funding to expand the project. And so, when it comes to having the experience and the skill sets in raising money and seeking for investors to grow your business, I'm a very valuable resource for you. So, what are our learning objectives for this course? The first is understanding the life cycle of your business. Okay, you will understand at what point your business is in its life cycle, and this is very important because there are different strategies that you need at different growth stages, and you need to understand how you can tailor those strategies at each particular stage of your business life cycle. The second learning objective is that you will understand the investor space, which is very key. I mean, you need to know what types of investors are out there, what types of opportunities are out there, so that you can stay ready and you can know how well to position your business. The third learning objective is getting your business portfolio investor ready. And we're going to deep dive into the 5 strategies that you can use to stay investor ready. And we're really going to look at how to build a strong pitch deck that gets funded. Finally, on a special bonuses on this course, we're going to talk about selling yourself. Okay, so you're going to really learn how you can articulate the value that your business is bringing to investors or to a potential investors within minutes of meeting an investor. We'll look at how you can build a strong appeal for your brand. And then also we'll review the templates that you should have gotten by way of purchasing this course. So the pitch deck template, the business profile template, and the investor portfolio list. So we'll review all that under the fourth and final section of this course. So yeah, this course is broken down into 4 different should I say sections, just so that it's not overwhelming for you. So, as I said, stick with me till the very end. It is going to be a very valuable use of your time. So, moving along, it is important to note that if you don't need funding, don't seek for funding. Okay. Um, if you are at the point in your business where you're not sure what you need, right, and how you're going to allocate the funding, where you're going to allocate the funding to, you should not seek funding or seek for investors. Okay, you should only seek and accept investor funds when it is absolutely necessary. That means you have a plan, you want to grow your business, you want to scale, or you have an idea, you need capital to launch. So it is very important for you to note that. Now, what are the mistakes that you should avoid, right, when receiving funding or seeking for funding from investors? These are common costly mistakes that potentially wreck small businesses. Now, the first one is, I mentioned this earlier, raising funds without a plan. This is very, very important. You must avoid this. In order to raise funds, or when you have a plan to raise funds, you need to have a plan in which you know the budgets, you know how to allocate the funding that you get, you can properly utilize those funding so that it's not wasted, so that you do not allocate funds to, to activities that will run your business down. So it is very important that you have a plan before you seek to raise funds. The second mistake that you should avoid is using the funds to hire more staff. Now, it is not bad. It's not a bad thing to hire staff, right? Especially if it's a critical, position, right? Which is quite critical to the growth or success of your business. So if it's, for example, if you are maybe launching a new app and you need a back-end engineer, I mean, that is a hire that is justifiable. But what you want to avoid is hiring a bunch of staff without having a proper plan on how that would translate to an increase in revenue, which is very, very key. So a common mistake that a lot of businesses or business owners make is that they get funding and then they're hiring a bunch of staff. And at the end of the day, I mean, we can all see what's happening now with the current economic climate. There's so many layoffs happening because, I mean, and then most times they're staff which maybe are not bringing as much value to the business as they should. So, except when you need to expand operations and scale is very important, you should be very careful with hiring. The third mistake to avoid is allocating the majority of your funding to cover expenses or debt. Now, depending again, right? If you have expenses, for example, you want to pay suppliers, right? You have to pay the suppliers because if you don't pay the suppliers, you might not be able to get stock if you're in the product business, right? It could be that you have a debt. Maybe it's a debt that is on your balance sheet, and you need to get it out in order for your business to grow. Except in those situations, you do not want to raise funding or raise money only to allocate a majority of that funding to expenses and debt, because at the end of the day, expenses are debt, and debt are not likely to give you to increase your revenue. So you need to be very careful to ensure that majority of the funding that you get is going to be allocated to activities that are channeled to growing your revenues and ensuring that you're getting a return on investment. The fourth mistake that you must avoid is allocating part of your funds for personal, non business use. I mean, this is extremely important. As a business owner, you need to separate personal from business, right? It's very, very important, especially when your business is, just getting started. You're in that startup phase. You do not want to start taking money from the business for personal use. Sometimes you hear of stories where business owners get this crazy funding and then they go and buy a house and buy a car. Like, you need to ensure that you avoid that, because that could potentially wreck your business. Um, the final mistake that you want to avoid is failure to diversify. When you diversify, you reduce your business risk, and also it ensures that your business is more sustainable. So you need to ensure that as you get funding and you allocate this funding, you are looking for ways in which you can diversify, because that is very key to ensuring that you're reducing your risks. For example, if you're in a product business, you have one product. What happens if something happens and maybe there's a regulation that comes up and that product is banned or is no longer going to be in circulation? I mean, the business would fold up, right? But if you are diversified, your different revenue sources, then you know that, okay, if a revenue source A is closed, then I have revenue source B and C from this and doing that. So it is very important that as you get your funding, you are thinking of ways in which your business can be sustainable, irrespective of the challenges that your business may be facing within the economy. So yeah, moving to the life cycle of your business, which is our first learning objective in this course. When I think of life cycle, I sort of think of the butterfly. It goes from the butterfly, it goes from the egg, it goes from the egg to the caterpillar, and from the caterpillar it goes to the pupae, and then it goes and becomes this beautiful butterfly. So in the same way, you can think of your business as transitioning through the different stages of its life cycle. And it's very important for you to know the different stages that exist within your business, so that it can help you to understand how well you can tailor your strategies to the different stages of the life cycle of your business. So moving on, these are the five key stages of a typical business life cycle. Now, please note that sometimes, again, it's not a one size fit all. There are some businesses that will not go through this stage, right? Because of the kind of business model that that business has. There's some businesses that from startup and launch phase, they go into expansion, right? They may not go through the growth phase. They're expanding rapidly, and then before you know it, they're going to IPO or being acquired, which is the exit or decline phase. So but typically, what you would see in the business life cycle is the startup launch phase, the growth phase, which is the next one, the expansion phase, the maturity, and then finally the exit or decline phase. So let's start with the startup launch phase. Here, the business operations have just begun. So, I mean, you started your business, you've registered your business, you're kicking off operations. Revenues are usually low during this phase. And usually the startup costs are very high. So here, the cost of capital, acquiring machines, if you are having a physical store, leasing a space, getting furniture, stocking up, buying products. So usually revenues are low and expenses are high in the startup and launch phase. So it's okay. Don't panic. Don't feel sad if you're not meeting your revenue targets. It's only for a short while. Some businesses don't even see profit until after 2, 3, or several years. But again, depending on the type of business model that you have. The second phase or stage, which is the growth phase, here you're seeing more consistency in revenue generation as you're beginning to build your user base, add on more clients, you're refining your business model, changing a few things, but then growing, leveraging the market, and adding new customers. These are some of the characteristics of this stage. Here you are also seeing the benefit of leveraging scale. As you begin to grow, you may start getting things in bulk, getting things cheaper. So these are some of the activities that you see within the growth phase. Moving on to the expansion phase, here you're scaling, introducing new services or offerings. You're getting into new markets. You may have started your operations in Lagos, but you want to open up in Port Harcourt or Abuja. Or if you're starting your operations in a country, Nigeria, you want to scale up your operations into other new markets. So you want to go to Kenya, you want to go to Ghana, you want to go to some other countries. So these are some of the activities or characteristics of this business life cycle stage. And here, of course, your revenues and profits are beginning to increase and grow quite steadily. You might start seeing profit here, which is great. Again, you might see profit earlier in the growth phase or much later in the maturity phase. It depends on your business model. So moving along, the maturity stage of the business here, your business has established its presence in the industry. It's known. Obviously, you are more of an expert, so you know your business. You've expanded. You're in new markets. You have multiple distribution channels already. Growth here has reached its peak, right? And of course, there's increase in competition because if there's a wonderful business idea doing well, you will have copycats, right? It's nothing to be afraid of. It's just to ensure that in this stage, you are doing all you can to stay ahead of the competition. It means that you need to innovate. You need to start thinking of how you can diversify, and how you can better serve your target audience or your customers or your user base. So in this stage as well, it's very important to learn how to adapt to the changing business environment because again, things are changing, right? And you don't want to be just stuck in your old ways where you have another competitor coming out and taking over the market and just putting your business down because you fail to innovate. So it's very important here in this phase to ensure that you are adapting to the changing business environment. So finally, looking at the fifth stage, Here's the exit, or you can call it a decline phase. So what happens in this stage could be, due to several reasons. One, it could be failure to reinvent or to, adapt to the changing business environment that, I had mentioned in the maturity phase. Once that happens, of course, you begin to see declining revenues because, your competitor is taking a huge chunk of the market. You're not growing anymore, or your product has become redundant, or your service has become redundant, and, people are not really finding value anymore. So your revenues are taking a nosedive. And at this point, some business owners choose to either, liquidate, sell their business. They could go into a merger or be acquired. I mean, we heard about the acquisition of, Paystack by Stripe. And sometimes the exit or decline is not necessarily because the business is not doing well. It could be a strategic alignment of, two different organizations to form a much bigger business entity. So yeah, when you think of acquisition, yeah, when you think of IPO, when you're taking your organization or your business public, it means you're selling out your shares to the public. And that these are some of the strategies that business owners usually take in the exit or decline phase of the business life cycle. So, just looking into the life cycle a little bit more. So starting with the startup launch phase, some of the challenges you will see again is maintaining cash flows. There's a lot of expenditure going out. Usually in the startup phase, you're constantly buying, you're constantly building, you're constantly, trying to position your business. So maintaining cash flows is something very important for you to look at, ensuring that you're keeping an eye on, what is going in and what is going out in terms of cash. You need to ensure that as much as possible you have cash to be able to run your business operations. Another thing to look out for in this stage of the life cycle of your business is establishing a user base, or having a steady flow of customer acquisition and retention. This is very key. At this stage, you want to ensure that you are getting customers and keeping your customers. You don't want your customers to come and then leave, right? You want to ensure that, at the startup or launch phase, you are fine tuning your services or your business model as much as you can from the feedback that you get from your users or your early customers. This is really, really key. And then meeting set revenue targets is another common challenge. As I mentioned, your revenues are usually low and your expenses are usually very high in this phase. So sometimes meeting revenue targets can be difficult. You might set a target for yourself for a quarter and not meet it, but not to worry. It gets way better as you move along in the life cycle of your business. Another thing to note in this phase is that you need to establish strong financial controls. Again, you need to keep your eye on the revenues, you need to keep your eye on your expenses, and there's so many platforms that help you manage your financials and put your financials together. There are apps that do that now. But you can also get a consultant, a financial consultant that can help and work with your business to ensure that you are really establishing those strong financial controls at this stage of your business. Investor funding is usually very small at this stage because in the startup or launch phase, it's the business is usually more risky. A lot can still happen. So the size of the investor funding at this stage is usually very small. We'll talk a little bit more, as we move along in this course, but yeah, it's usually really small because a lot more work is needed to raise funds at this stage. Obviously, you need your proof of concept. You need to show traction, that people have purchased your product, that your whatever product or service you have is meeting a need. So there's a lot of work that, needs to go into trying to put that value out there and sell your business for you to raise funding at this stage. So you have angel investors, family and friends being investors, common investors in this stage of the business life cycle. Now, moving on to the growth phase, some of the challenges you find is, increasing market competition. As I said, a great idea out there, you're bound to have copycats. So there's going to be stiff competition, and that's usually a challenge in this phase. Ensuring that you are differentiating your product or your service. Another thing to look out for is the effective management as your company grows. Sometimes if you get the service of a business for the first time, it's usually very excellent, very nice, and then suddenly you find out that 4, 5, 6, 7 months down the line, the service is not as great as day one. So it is not easy in the growth phase because you need to ensure that you are getting effective management. If at the startup or launch phase you are a solopreneur, right? You're just the only one running your business and doing several activities of your business. When you are growing, you will need more hands, and not just any hands, skilled hands. So this is very important to note in this stage, that you need to have an effective management team and start putting together a team that can help you maintain that excellent customer service, because that is also another challenge of the growth phase, maintaining that excellent customer service from day one. Now you don't have 5 or 10 clients, you have 50, you have 1,000, 200, 2,000. How do you ensure that you are providing that same excellent service to a growing number of clients or customers? Um, Another challenge here with this phase also is establishing strong financial controls. It is similar to the startup or launch phase. I mean, you need to keep your eye on cash as you begin to grow. You need to have very, very strong controls on, how money is going in, how money is coming out, and having a budget, right, that really guides the spend, which is very key. You have to have a budget and stick to the budget. Budgets can be adjusted, right, as you move along, but having a budget that guides spend is very, very key. So some of those are some of the controls that you want to put in place. It's much easier raising funding in this stage because I mean you've grown. It shows that your business has traction. It has it's solving a need, right, in the market. So you have people who need your product or your service. So it's much easier to convince an investor, to invest money in your business. So here you begin to see more of the private equity firms, also known as venture capital firms, who are a bit more interested in businesses, organizations that are in the growth phase, because it's less risky than the startup or launch phase. So yeah, moving along to the expansion phase. Um, Increased competition is a common challenge here. Of course, there's the need to differentiate yourself from the other competitors and to really show how you are adding value beyond what other competitors are currently giving to their clients. Entry into new markets is also another unique challenge of this phase in the life cycle. Here, you're entering new, it could be expanding operations in a new country or in a new state or in a new city. Of course, that comes with its own unique challenges because it's not a one size fit all. Whatever happens, however your operations are in Nigeria, it's going to be different in Ghana, right? Because that different people, the culture is different. You have to hire a team, understand the cultural differences and how you can position your product or your service. So yeah, entering into new markets is part of the activities you see in this phase, and it comes with its own unique challenges as well. Expanding your existing business through additional offerings or increasing your product portfolio is also another common activity within this phase. Again, you want to diversify and increase your product portfolio because you want to ensure that you are having a business that is sustainable and you are expanding your revenues. The business risk in this stage of the life cycle is lower because I mean you've grown, you are expanding, you're an expert in the field. So this helps you get even bigger investment opportunities, opportunities from investors. And this is really, really great. Venture capitalists and then bank loans as well can apply in this phase of your business life cycle. We'll talk more about the types of investors and understanding the investors when we get to understanding the investor space. But here, the venture capitalists and bank loans are usually common sources of funding in this phase. I mean, with bank loans, you'd mostly find banks wanting to give loans or easily giving loans to organizations or businesses that are in the growth or expansion phase because, I mean, again, it's less risky, and usually they don't like to take huge risks like the angel investors or with family and friends. So moving on to the maturity phase of your life cycle of your business, increased competition as well, battle for larger market share, may continue to enter new markets and expand existing business as the opportunities arise, depending on your business model. The matured businesses are usually, I mean, it's much easier to raise debt financing, similar to bank to loans. With debt financing, you're pretty much asking for funding, in which you will pay back at an agreed interest rate over a specified period. So that is debt financing, and it's different from equity, which is giving parts of your business, which we look at as shares, to the investor. So we'll discuss a lot more about this in the coming sections of this course. Um, but yeah, you have the venture capitalist and also bank loans being frequent sources of funding for this stage. So moving on to the final stage of the life cycle of a business, with the exit, as I mentioned earlier, the business owner or founder may decide to exit the business for various reasons, opportunities, that may abound, but there are implications for the ownership structure of the business. So if you're doing an IPO where your business is going public, you're selling your shares to the public, and that business is no longer owned by you or your co-founders. It becomes a public traded company, and also there are implications around the employee management. What happens to the employees when you are exiting the business? How do you maintain business continuity? These are some of the things that you need to think about when exiting, and usually an exit plan is needed for a successful exit. So you're sitting with your management team or the other stakeholders in your business, and you're drafting out an exit plan to ensure that the exit is successful. So, what are the key takeaways for this section? The first is to tailor your strategies. Every stage of the business life cycle really brings new challenges, right? And a solution that may have worked for one stage may not work for another stage. So that is important for you to know. Um, the second thing is to stay focused. Avoid a one size fit all approach to each stage of your business life cycle. You need to ensure that you are tailoring the unique strategies that you have to the uniqueness of each stage of your business life cycle. And then finally, plan ahead. I mean, you require financial funding or financial support at the different stages of your business life cycle. So plan ahead. Have a plan, have a financial plan, have a budget, have a strategic plan for each stage of your business, of the life cycle of your business, right? Because this would help you to overcome whatever challenges that you might face at each stage. So yeah, I hope you found this section really, really valuable. Yeah, take a break, take a sip of water as we move on to the next sections. Yeah, see you and thank you.